Hello guys. So we are three sessions down on assessment procedure. So we've seen when return has to be filed, what is the due date of filing return, who are mandated to file the return of income, what happens in case the assessee incurs a loss, is there any specific condition, are there any specific conditions for that, what are the conditions for filing a belated return where I am unable to meet the 139.1 deadline. So this is what we have seen so far. Now, what the income tax department did was they told we are happy that we've come out with an extensive procedure. So let us quickly take stock and see how many of them have filed the return of income. So as usual, they came out with the list of assessees who have filed the return of income, and then they decided to check the status of these assessees. What were they doing? What was the nature of assessee? And when they tried to filter this out, they noticed a small problem. What problem? They were unable to find a single charitable trust or a single religious trust which had filed their return of income. Okay, so let us take for example, there is an orphanage. Okay, let us call it ABC orphanage. There is an orphanage, ABC orphanage, ABC orphanage. This ABC orphanage is a charitable trust, and they have not filed the return of income. Okay, and based on the transactions that they have received and from the bank account of this particular trust, the income tax department is able to identify that they have received donations worth 50 crores. So for FY 2021-22, ABC Orphanage has received 50 crores worth of donation, but they have not filed their return of income. The department was concerned. They raised a notice, they issued a notice to ABC Orphanage and they asked them, boss, please tell us why you have not filed the return of income. ABC Orphanage promptly responded. They came and told, sir, please read section 139.1. What have you told? Companies are mandated. We are not a company. Partnership firms are mandated. We are not partnership firm. Those who are subject to audit under partnership firm or whatever be the nature, sole proprietary concern or whatever be it, they are mandated. We are neither of all those cases. Now, you have got another case. What is that other case? The other case is that if the total income before exemptions under section 54 series or before consideration of chapter 6A deductions is more than the basic amount chargeable to tax or maximum amount not chargeable to tax. Now in this case we have no such a situation because our exemption does not correspond to section 54, 54B, 54D, 54EC, 54F, G, GA, GB. Our exemption stems from section 11 and section 12. We being a charitable trust, we enjoy the benefit of section 11. So therefore, we are not subject to this exemption under section 54, nor are we bound by this 6A deductions because even before 6A deductions, our income becomes nil, taxable income becomes nil. Now, there was a problem. What problem? Whether these charitable trusts are correctly engaging in the activities, whether these charitable trusts are complying with the conditions. Because if you have to enjoy the benefit of exemption under section 11 and under section 12, there are a series of conditions laid under section 12A, 12 capital A. Don't worry, we will look at it when we do the charitable trust topic or trusts topic, trust taxation topic. We'll separately cover the depths of this particular topic. Now, what happened? They wanted to know whether the benefit claimed here under what section. They have claimed benefit under section 11 and under section 12, whether this is genuine or not. The department wanted to find out because we do hear stories, we do watch movies where illegal black money is converted into white in the form of charitable, religious, or whatever be the nature of trust. And again, whether these trusts are being truthful in terms of the eligibility for exemption or not was a concern. So what they did, they amended section 12A. What is this 12A? Conditions required for enjoying the benefit under section 11 and 12. So what did they tell? Where the income of the trust is greater than maximum amount not chargeable to tax, maximum amount not chargeable to tax before giving effect to 11 or 12 exemption. So what did they tell? Where the income of the trust before giving exemption under section 11 or 12 exceeds the maximum amount not chargeable to tax, then these trusts shall get their books of accounts audited under section 44AB. Okay, so they will get their books of accounts audited. Now, these trusts are going to get their books of accounts audited. Now, they didn't stop there. Then they introduced a new section. What section? Section 139 4A. 139 4A. So, what did this 139 4A tell? Any religious trust or any charitable trust which has total income before giving exemption under section 11 or 12 greater than the maximum amount not chargeable to tax, then they will be mandated to file the return of income. Now, please understand, these sections are not talking about the taxability of trust. They are not bothered about whether the trust is getting taxed or not. They are more concerned about whether the books of accounts of the trust are audited under 12A and whether the return is filed under section 139 4A to see the genuineness of the exemption, genuineness of the activities carried out. That's all. So 139 4A, what is it telling? Where a trust has income before giving effect to the provisions of section 11 and section 12 is greater than the maximum amount not chargeable to tax, then they shall be mandated to file return of income. Now, when I use the word maximum amount not chargeable to tax, it also indicates that the tax rate applicable for a trust is based on the slab rate that we already know, up to 2.5 lakhs, nil 2.5 to 55%, etc. Okay, so this is how we'll have to understand the provision when it comes to trusts. So 139 4A talks about trusts. Now the next question that we will get is, sir, we've seen 139 4 which talks about belated return. Can trust file belated return? Yes. Trust can file belated return. There is no restriction because 139 4 does not tell this provision shall not apply to a trust. No, such kind of a wording is not given under section 139 4. 139 4A is for what purpose? Mandating the filing of return of income, which brings us to the second question, whether they can file a belated return. Yes. Sir, you're telling they can file a belated return. What about the original return? What is the time limit? Now, get back to 139.1. What did 139.1 tell about timing? Where a particular entity is subject to audit. Where a particular entity is subject to audit of books of accounts under tax audit or under any other provisions for that matter, will be having their due date as 31st of October of the relevant assessment year. So the due date under section 139 4A is 31st October of relevant assessment year. Sir, so 139 4A does not talk about time limit? No. 139 4A depends upon 139 1 for time limit. Time limit is always calculated by 139 1 and 139 4. 139 1 for regular return, 139 4 for belated return. Is it clear? So 139 4A, what does it talk about? Where any religious trust or a charitable trust which has total income more than maximum amount not chargeable to tax before granting exemption under section 11 or under section 12 and under section 12, then they are mandated to file the return of income under section 139 4A. Don't be bothered about audit for now. I just stressed upon the audit to give you an indication that the due date is going to be 31st of October. From an assessment procedure point of view, the audit of trust is not a concern. The concern point is, what is the due date? Due date is 31st of October. Why is 31st of October? Because 139 4A depends upon 139 1 for time limit. 139 1 clearly specified that where there is an audit criterion, then the due date is going to be 31st of October of the relevant assessment year. Fine. Now, sir, we were talking about consequences of belated return. Now, is there any specific consequence for 139.4a? Because what did we tell? There is one section called 234f, which talks about a fees that will be levied 5,000 if your total income is more than 5 lakhs, and if it is less than 5 lakhs, the fees will be 1,000 rupees. This is what we have seen under 139.4. The same rationale will apply for a trust as well. So, fees under section 234F applies to a trust. So what happens? Trust will also have to bear the fees of 5,000 if the total income is going to be more than 5 lakhs, or less than 5 lakhs, then they'll have to bear a fee of 1,000 rupees. In addition to this, there is a penalty under section 272A, which is rupees 500 per day from 1st April 2022. 1st April 2022 onwards, when there is a delay, you will be subject to 500 rupees per day delay from the end of the due date till the date of filing return of income. So, for example, the due date of a trust is 31st of October. I filed return on 20th of November. So, 20 days I will have to file, I will have to pay the fees when I file the return of income. So 20 into 500, that will be 10,000 rupees. Is it clear? So this is what is the penalty clause when it comes to filing of belated return for a trust under section 139.4a. So what have we seen so far? We have seen that charitable trust and religious trust will again be subject to provisions of return filing, and the section which was brought for this purpose is section 139.4a, and where the income of the trust before giving exemption under section 11 and 12 exceeds the maximum amount not chargeable to tax, then this would result in them mandatorily filing a return of income. Since trusts which have basic exemptions exceeded by their total income before exemptions are subject to audit, therefore the time limit for 139.4a is derived from 139.1. Therefore, the due date of filing the due date of filing return of income by any religious trust or charitable trust is 31st of October of relevant assessment year. In case there is going to be a delay, whether they are eligible to file a belated return, yes, they are eligible to file a belated return. What will be the consequence? They will be subjecting themselves to this fees under section 234F, where they will have to remit 5,000 rupees if the total income is going to exceed 5 lakhs. If it is below 5 lakhs, they will have to pay rupees 1,000 as the fees. Is it clear? So this is with respect to section 139.4a. Now, let us go to section 139.4b. Now, after bringing charitable and religious trust within the ambit of return filing, department was once again overjoyed. They went and checked who all have filed the return of income, and they were again disturbed by one fact. What was this fact? Not a single political party had filed the return of income. Now, here we are talking about provisions. There is no political satire or probably no sarcasm intended here. This is only to understand the provision. So please don't think that I am mocking at political parties or politicians. No, we are just trying to understand the evolvement of these provisions. That's all. So what happened? They understood that no political party has filed the return of income. Then what they did was they selected 4-5 political parties and they sent out a notice asking, boss, please explain why you have not filed the return of income. Political parties responded, boss, please try to understand. I have gone through the provisions of section 139.1. It says company, firm, mandatory, other persons if the maximum amount not chargeable to tax before 54 series exemptions and chapter 6A reduction is more than the basic amount not chargeable to tax, they are mandated. We are not covered there. We also went through your 139.4a. It says charitable trust, religious trust. Still we are not covered. We are claiming exemption under section 13A, which is totally different from whatever you guys have discussed so far. Therefore, if you see our income before 54 series exemptions, before 6A deduction itself is zero. Now department understood, fine. Because of that drafting, what has happened, people claiming special exemptions or specific exemptions are getting ruled out. Specific exemptions or special exemptions are getting ruled out. So we'll now have to address this situation as well. We'll have to arrest this situation. So what they did was they introduced another section. What section? Section 139 4B. It applies to political parties, okay, whose total income before exemption under section 13A is more than the maximum amount not chargeable to tax. So hint number 2, even for political parties we will be following the slab rate. Don't worry, political party taxation, electoral trust, etc. we will be separately looking at as topics which will be discussed upon. For the moment, just understand the impact from an assessment procedure or return filing point of view. Don't go beyond that. I will definitely cover it before your examination with sufficient time. So, political parties which have total income before claiming exemption under section 13A, which is more than the maximum amount not chargeable to tax, then mandatory return filing. So they will be mandatorily required to file the return of income. Now, the next question will be, sir, what is the due date? Now, again under section 13A, where the total income of a political party before claiming exemption under section 13A exceeds the maximum amount not chargeable to tax, they will be subject to audit. They will be subject to audit. If any person is subject to audit, what is the due date? The due date will be 31st of October of relevant assessment year. So, political parties who have total income more than the basic amount not chargeable to tax before exemption under section 13A, then the return filing for such political parties are mandatory and the due date shall be 31st of October because they are also subject to mandatory audit under the provisions of section 13A. Is it clear? No. Sir, you are telling that 139.4 belated return was applicable for charitable trust. Is it applicable for political parties also? Yes, definitely they are applicable to political parties. Sir, 234F applied to charitable religious trust. Will it apply to political parties? Yes. 234 as a fees will be applicable to every kind of assessee who is required to file return but does not file the return within the due date under section 139.1. Again to note, the due dates are always derived from 139.1 for regular return, 139.4 for belated return. So these two sections are cardinal for you to remember. Whenever a question on due date is asked, remember, check the question whether they have asked you for normal return or they have asked you for belated return. If they have asked you for normal return, always remember, irrespective of the type of assessee, you will always go back to 139.1. Then you will check whether he is covered under audit or not, whether he is covered under transfer pricing provisions or not. If nothing, he is getting covered under 31st of July. If he gets covered under audit, not under transfer pricing, 31st of October. Covered under audit, covered under transfer pricing, 30th of November. So remember this cardinal rule. If it is going to be belated return, it is going to be 31st of December or completion of assessment, whichever is earlier. This will never change. But applicability of filing of return might get derived by various sections. So for example, 139.1, 139.1c gives certain exemption, and then you have 139.4a, 4b, 4c, 4d, 4e, 4f. So you will have to look at it like this. But for due dates, it is fixed. 139.1 regular return, 139.4 belated return. Now, so this 31st of October of relevant assessment year is going to be the due date of filing return. Whether they can also file belated return, yes. Whether 234F fees is applicable or not, 234 fees, 234F is applicable for a trust. However, 272A is not applicable for political parties. Political parties 234F is applicable. 272A 500 rupees per day. Before 1422 it was 100 rupees per day. After sorry, after 1422 it has become, that is 1422 onwards, it has become rupees 500 per day. Okay, so this is the provision with respect to 139.4b which applies in case of political parties. Now quickly go back to the notes that I have given. So this now you can refer, so you will be able to understand better. So 139.4a it applies to charitable trust or religious trust availing exemptions under section 11 and 12 of Income Tax Act. Now what are the conditions? Total income before considering exemptions under section 11 or 12 is more than the maximum amount not chargeable to tax. So what are the conditions that they have specified? They should have total income before considering 11 or 12 chargeable to tax should be more than the maximum amount not chargeable to tax. Then only you will be subjecting yourself to mandatory return filing. Okay, so what is the due date? As we have already understood, section 12A mandates an audit. Therefore audit derives its due date from 139.1, which tells that in audit cases the due date is going to be 31st of October. Sorry, here it is not 30th, it is 31st of October of relevant assessment year. Now, what are the consequences in case you are unable to file? Then you will be subjecting yourself to fees under section 234F, either 5,000 or 1,000, and penalty under section 272A at rupees 500 per day of continuing default. 100 per day was up to 31st of March 2022. So this is with respect to charitable trusts. Now, with respect to political parties, they should avail exemptions under section 13A, then they are covered under 139.4b. Conditions: total income before exemption under 13A is more than the maximum amount not chargeable to tax. What is the due date? As I told you again, 13A mandates an audit to be carried out if the total income before exemption is more than the maximum amount not chargeable to tax. If there is an audit, please refer 139.1 for time limit. It is 31st of October. Therefore, here again it will be 31st of October. Sorry, it is not 30th, it is 31st of October 20, of the relevant assessment year. Now, what are the consequences? Consequences is going to be only with respect to section 234F fees that will be levied. Clear? Now, department once again went back, and before doing the exercise, they became clever this time. They became intelligent this time, so they wanted to check if there are any more assessees who are enjoying special benefits. Then they came out with a huge list. Special cases where there are special benefits that were availed by various assessees. Now this is already given as part of your handouts case. Just one small point, an examination point. Whenever you prepare for your examination, from day one till you walk into the examination hall, make sure you stick on to one material. If it is going to be, let us say, T.N. Manoharan sir's material, please stick on to T.N. Manoharan sir's material. Singhania sir's material, Singhania sir's material. Vinod Gupta sir's material, Vinod Gupta sir's material. G. Shekhar sir's material, G. Shekhar sir's material. Banwar sir's material, Banwar sir's. Do not keep switching. Do not keep changing. Have faith that whatever book that you have chosen is the best. Changing a book will seriously damage your exam scores. You might be capable of scoring 80 marks with Banwar sir's material or T.N. Manoharan sir's material, but if you change the book, though the law remains to be the same, changing a book does impact. Changing a book does impact your performance. So stick on to one book. Never touch another book. Take your time to choose the book. The moment you choose a book, stick on to it. Believe that the book will do wonders for you. It will do wonders for you, no matter what book you choose. Okay, so don't keep changing. Sir, can I refer Banwar sir's book for one subject, one topic, and T.N. Manoharan sir's No, don't do that. You take a book, you do it in totality. These handouts that I give you are for more understanding point of view, and then you can quickly check the examples that I have given to see how to approach. That's all. Otherwise, you stick on to whatever book you study. Okay, the entire YouTube session that we are doing here is to give you more clarity onto the subject and to make studying the books easier. I am not going to teach you a different type of income tax act, or the books that you study are not going to project a different types of income tax act. So please be confident with whatever book you choose. That's it. Okay. So now what happened? This time they did a workaround and they found out that there are these many assessees. Sorry, there are these many assessees who have certain specific exemptions. So, for example, ISRO. So, ISRO has this exemption under section 1021. So, whatever income that they have will be fully exempt. Now, Press Trust of India. So, PTI, again, whatever income they get is fully exempt because they are registered under section 1022B. Then here, so CA Institute, CS Institute, and then you have your CWA Institute, which is no longer CWA, Cost and Works Accountant or Cost and Management Accountant or whatever. Those institutes are getting covered under section 1023A. And then, excuse me, 1023C, this Cancer Institute in Chennai. Likewise, there are various institutes across India which are indulging themselves, who are indulging into the object of research with respect to medical sciences and also provide free medical treatment or subsidized medical treatment. Then they are given this benefit of section 1023C, where the income is not subject to tax. Always mutual funds, the unit holders are subject to tax, whereas the mutual funds are generally are given the benefit of exemption. Same holds good for securitization, investor securitization trust, and then investment protection trust, and then core settlement guarantee trust, venture capital fund, trade company, trade union, and then you have the infrastructure debt fund, etc. Now, some of us might have this doubt, sir, should we remember all this? And you have not explained of each of them, so we don't have to know what each of them are. The frequently tested ones, if you see from the examination point of view, this associational institution 1023A is getting tested quite frequently. Public charitable trust sometimes will get tested. 1023B, 1023C is again a favorite point, and 1023DA being a new topic, it gets tested. And then 1023EE, core settlement gratuity fund, gratuity guarantee fund will get tested, and then 1023FB will get tested, and then 1047. Beyond this, they will not test you. So you don't have to remember this by heart. You don't have to remember this listing by heart. I have taken the listing from the BAR Act. So what I would suggest is take 3 of these every day. Just read what they are. Just read what they are. That's enough. Do this process for 10 days. Over 10 days, you will obviously remember at least 10 or 15 of this entire list. 10 or 15 of this entire list. So there is not much for you to remember. So don't worry. Even if you want to remember, what should we remember? Please remember 1023A. Okay, frequently tested. Then 1023C could be another frequently tested one. And then 1023B could also be frequently tested ones. Mutual fund, you don't have to put efforts to remember. Securitization trust, you have to remember because it is a recent uproar that is being done in terms of securitization trust, and they frequently keep testing students on the securitization trust. Core guarantee fund, core settlement guarantee fund, and then venture capital company or venture capital fund, and then infrastructure debt fund. So these, if you remember, are more than enough. Okay, now sir, suppose they ask us beyond this. That's why what I would suggest is keep spreading this. Don't study in one day 1021 research agency, 1022 news agency. Don't do that. Take up only 3 per day. Repeat this for the next 5 days. So on the 5th day, you will definitely know by heart what the first 3 items are, and you will likely be able to recollect the next 3 also. So you have sufficient time. Just remembering this remembering 3 items per day is not a big task. Studying the entire list, getting frustrated might seem laborious. So that is why you can split it up and study so that you will definitely remember it. Okay, so now department identified that these are the organizations which are getting special exemptions, which will not get covered under section 139(1). Why? because 139.1 talks about only 54 series exemptions. Likewise, they won't get covered under section 139.4a. Why? Because 139.4a covers 11 and 12. They won't get covered under 139.4b. Why? It covers only 13a. So they brought in a new section 139.4c. So what was this section? So these institutions, if they have total income which is more than the maximum amount not chargeable to tax before claiming exemption under these sections. So for example, a mutual fund has total income of 2 crores and the exemption under section 1023D is also 2 crores. 2 crores, right? So 2 crores. If this is the case, then whether the mutual fund has total income more than maximum amount not chargeable to tax before 1023D, yes, then they have to file the return of income. Let us take CA Institute. Now CA Institute, let us say for example, has an income of 15 crores. Okay, and they have claimed exemption under section 1023A for the entire 15 crores. Now, what is the income before 1023A exemption? It is 15 crores. So they are mandated to file the return of income. So 139.4C specified that where these institutions, it has listed out the institutions, where these institutions or persons are having total income more than the maximum amount not chargeable to tax before exemptions under these sections, they will be mandated to file the return of income. So before considering the exemption exceeds the maximum amount not chargeable to tax, the above assessees shall be mandated to file the return of income. What is the due date? Now 139.4a, 139.4b had a mandatory audit clause. 139.4a, 139.4b, the conditions for audit and the conditions for return were one and the same. Your income has to exceed the maximum amount not chargeable to tax, audit. Income exceeds maximum amount not chargeable to tax, return. So 139.4a, 4b had the same condition. If your total income is more than basic exemption, audit, return. Same thing applied for these two, but here they did not give such a condition under these sections. These sections did not have such a condition. 13A and 12A were telling that audit was mandatory. Under those respective sections itself, audit was mandatory. Here, these sections do not give any conditions for audit. So, in that case, regular provisions of audit will apply. So, for example, if there is any profession that is carried out by any of these institutions, 50 lakhs will be the threshold. If it is going to be business, it is going to be 1 crore, or if they comply with the conditions of 44AB, 10 crores, etc. So, some of them might get covered under tax audit provisions, some of them might not get covered under tax audit provisions. So, the next question was, sir, what is the due date of filing return? If any of these institutions get covered under tax audit provisions, 31st of October. If none of them get covered under tax audit provisions, 31st of July will be 31st of October of the relevant assessment year. Otherwise, the due date shall be 31st of July of the relevant assessment year. Guys, and throughout this notes that I have given, if there is 30th of October anywhere, I will try to correct it and then share it with you. But please remember, there is no such date as 30th October. It is 31st of October only. Okay, so so the above entities, if they are subject to provisions of audit, then the due date shall be 31st of October of relevant assessment year. Otherwise, the due date shall be 31st of July of the relevant assessment year. Now, the next point, sir, 139.4a, 4b, both of them you told belated return is possible. For this provision, 139.4c, is it possible? Very much possible. Even for 139.4c, belated return is possible. Sir, if belated return is possible, due date, we will definitely take it from 139.4 only. Sir, if belated return is filed, 4A, 4B, you give consequences. Likewise here, yes, same consequences, but 272A will be applicable for 139.4C. So, here 272A is applicable. So, rupees 500 per day. This provision, rupees 500 per day of continuing default, applies for 139.4a and 139.4c. It does not apply to 139.4b. This provision applies only to 139.4a and 139.4c. 139.4b, no 272a penalty. Sir, what about 234? 234 will apply wherever there is a return filing condition and there is a delay in filing the return. So 139 4A, 4B, 4C, 234 S is F is applicable. 139 4A, 272A is applicable. 139 4B, 272A does not apply. 139 4C, 272A is very much applicable. Is it clear? Now, there is one interesting point with this section. What is that? Let us say that there is one health center. Okay, there is one health center which is an educational institution and hospital. This is an educational institution and hospital. This health center has been granted exemption under section 1023C. This health center, what it does is it tries to provide education and it tries to provide virtual simulation to doctors who are under the process of getting qualified. Okay, more like an articleship for doctors, but in a virtual situation, virtual scenario. Now, there are 5 conditions based on which this 1023C benefit is extended to this health center. So this health center is given the benefit under section 1023C by telling that boss, you will have to comply with 5 conditions. Condition number 1, you should always ensure that there are 100 patients in the hospital. Condition number 2, you should always have at least 30 students who are undertaking their internship. Okay. Number 3, you have to show a success rate of 85%. Like this, there are 5 conditions. Okay, there is no law for this. I am just telling you there are 5 conditions. For example, now these fellows, this health center has filed their return of income because of 139.4C. They had an income of 25 crores. They had an income of 25 crores. So they filed the return of income under section 139.4C. Now what happened? Department got the return of income. The assessing officer who was checking the return of income knew that this fellow is claiming exemption under section 1023C. Then he asked them to submit, please provide the approval from central government, where they would have told that, boss, you are eligible for 1023C, please claim the exemption. So central government will give you an approval. So they asked for the approval. When they checked the approval, they found out that there are 5 conditions. Now, all 5 conditions have to be satisfied if you have to claim the exemption under section 1023C. Now, this hospital, one of the conditions was that there should always be 100 patients. Throughout the year, there were only 30 patients. And throughout the year, only 10 students were there in this health center. Department became suspicious. Now, you have only 10 students, you have only 30 patients. Where is the question of 50 crores worth of income? 50 crores worth of income. So they immediately told, boss, we are finding this to be a suspicious activity and you have not paid a penny of tax by claiming exemption under 1023C. You have income of 50 crores. You are telling I am eligible for 1023C. You are telling I am going to not pay any tax. But there are 5 conditions. If you satisfy them, only benefit can be given. You have gone ahead and not satisfied 2 out of those 5 conditions. So we will not grant you that benefit. We will add back 50 crores as income. So please pay tax. Pay tax on 50 crores. So the assessing officer says this. Is it possible? It is not possible. Now try to understand. The benefit of 1023C was not given by the assessing officer. Only if you give a benefit, you will be able to withdraw the benefit. The benefit is given by the central government. Assessing officer does not have power to remove the benefit granted by central government. Sir, what is this, sir? If you tell like this, then all health centers will misuse this provision. No, sir. Correct. So to address this, 139.4C specifically came out with one more point. What did it tell? In case there are some conditions which are not satisfied or there are some conditions violated, assessing officer has to make note of this condition and intimate it to the central government. Central government will come back, check whether there is a deviation, and then they can remove the benefit extended under section 1023C. Only then you can force the health center to pay tax in this regard. Now, this condition applies to all these cases. So, whenever a condition based on which exemption is granted is violated, then the assessing officer is aware of such a violation, has to apply to the central government, intimate to the central government that there is a violation of condition, so benefit cannot be granted. Central government will come and check whether there is a genuine violation or not. If there is a genuine violation, then they will remove the benefit granted under 1023C. You will have to pay tax. If they are satisfied that no, there is no such change, then you will not be forced to pay tax even by the income tax authority. Is it clear? So this was the additional point which was not there. It was not there with 139.4a, 139.4b. 139.4c tries to address this particular issue in a slightly different manner. That's the only difference. So what have we said here? AO cannot deny exemption under the sections mentioned above for violation of conditions based on which exemptions are granted. So as I told you, 5 conditions, 3 only satisfied, 2 are not satisfied. AO cannot tax that 50 crores. What can he do? AO may notify CG on violation of conditions based on the same. CG may remove the exemption granted. So he can only intimate CG. CG may remove it or CG may choose to keep it as well, telling that no, there is no such a violation. Only after such a removal of exemption can the AO pass an order denying the exemption to the assessee. Okay, so once this order is going to be received and the AO is satisfied that yes, the government is also satisfied that there is a violation, then the health center will be taxed for 50 crores. Okay, is it clear? Fine. So this is with respect to section 139.4c. Now, we have studied under PGBP. In your intermediate itself, you would have studied. There are 2 sections, 35.1 clause 2 and then 35.1 clause 3. So, by 35, you must all vaguely remember it pertains to scientific research, correct? 35.1.2 belongs to scientific research. 35.1.3 belongs to social and statistical research. So what is this 35.1.2.1.3? Any company or any business, any person carrying out business or profession makes a contribution towards scientific research, it gets covered under section 35.1.2. Now, any person engaged in business or profession who contributes towards social and statistical research, he will be given benefit of a 100% reduction for such a contribution under section 35.1.3. So, a person carrying on business or profession should contribute for scientific research or should contribute for social and statistical research. To whom will he contribute? He can contribute to university, college or other institutions. So there should be a university, college or other institutions which are either carrying out scientific research or social and statistical research. Then the person contributing will be eligible for deduction. Now the question is, sir, how do we know that whether these institutions or organizations which receive these contributions utilize it for the set purpose or not? How do we know that they are not misappropriating it? How do we know that they are not evading tax on it? Because the contributor gets a benefit and the recipient will also have some benefit out of this. So to check this, income tax authorities had come out with a new provision, section 139.4d. Irrespective of whatever be the income or loss, irrespective of whatever be the income or loss, section 35.1.2, 35.1.3 institutions, universities and colleges must file their return of income. So they have slightly changed the word. 139.4a, 4b, 4c, income greater than maximum amount not chargeable to tax, you will be taxable. Now, I don't bother, I'm not bothered about your income. I'm not bothered about your loss. Please file the return of income. So this is the change of tone with respect to section 139 4D. So 4A, 4B, 4C gave the income cushion of a slab rate. 4D did not give that cushion at all. So irrespective of your threshold, you have to go ahead and file the return of income. Is it clear? So that is with respect to section 139 4D. Even if you incur a loss, being an institution, college, or whatever a university, you will be subject to filing the return of income. Now please understand, 139 4D is not for the person contributing. It is for the person receiving these contributions, whether they are utilizing it properly or not. To identify that, they have brought in 139 4D. So let us repeat, 139 4D, any institution which carries on scientific or statistical research and receives contribution under section 35.1.2, 35.1.3, etc., they have to file return of income irrespective of the fact whether they have made any profit or loss during the year. Now, what is the due date? Due date will generally be whatever is the due date under section 139.1. They may generally not be subject to tax audit, so it is going to be 31st of July, which will be the deadline. In case they are subject to tax audit, it may go to 31st of October, but generally tax audit will not be the criterion over here. Now, what do we do for this in the examination, sir? Please remember, these are all institutions which always follow the 139.1 due date only. So you can simply state by telling that it is going to be 139.1 due date. What if they fail with the 139.1 due date, and can they file a belated return under section 139.4? Yes, the belated return concept is very much applicable. They are eligible to file a belated return. However, 234F fees will be applicable. Sir, 272A? No. 272A applies only for 139.4A, 139.4C, not for any other section. Now, what happened after this? This business trust became a new concept which started gaining a lot of importance in India. And so what they wanted to do was, there were certain exemptions granted to business trust to ensure that business trust is staying within the four corners of exemption. They mandated business trusts to file the return of income irrespective of loss or income. So if you are a business trust, you will have to file return of income whether you have loss, whether you have made profits. They are not bothered. What is going to be the due date? Due date is going to be again in line with 31st of July, which is the 139.1 due date. Okay, and then in case of belated filing, again 234F will apply, no 272A, because it applies only to 139.4A and 139.4C. Now, investment fund under section 115UB again is not required to file under any other provisions. If they are not required to file under any other provisions, then they will get covered under section 139.4F, where irrespective of loss or gain, they will be mandatory required to file the return of income. What is going to be the due date? 139.1, and the fee of 5,000 or 1,000 under section 234F will be applicable for these assessees as well. Now, to understand once again, 139.4A, 4B, 4C will be applicable only when you have income greater than maximum amount not chargeable to tax before claiming exemptions under those respective sections. For 4A it is 11 and 12, for 4B it is 13A, and for 4C it is going to be under those respective sections. Now, with respect to 4A and 4C, 272A penalty of ₹500 per day of continuing default would be applicable. However, for 4B this does not apply. 234F applies for all these three cases, and the due date for 4A and 4B is 31st of October due to mandatory audit, and for 4C, depending upon the nature of, depending upon the applicability of tax audit, it may either be 31st of October or 31st of July. So this is up to 139.4C. 4D, 4E, 4F, mandatory return filing irrespective of the profit or loss that you incur. Okay, and then you will have to file it within the 139.1 due date, which is generally 31st of July. In case of tax audit, which may generally not happen, will be 31st of October. Now, sir, when will tax audit be applicable? Again, depending upon the nature of institution concerned, there may be tax audit, or there may be bylaws which will govern other audits which will require them to get it audited on 31st of October. Okay, suppose for example there is a society, then the society will be covered under the Societies Act, and the societies, cooperative societies, will generally mandate you to get the books of accounts audited. So in those cases, it may go up to 31st of October. But in the lack of clarity in questioning, always specify that the due date of filing the return of income shall be in accordance with section 139(1) of the Income Tax Act for 4D, 4E, 4F. 4D is for 35(1) to 35(1)(3) institutions, 4E is for business trust, and 4F is for investment fund under section 115 UD. So this is with respect to the special provisions of return filing. Okay, so having understood this, excuse me. So having understood this, what have we come so far? What have we understood so far? So we've understood what are the cases where return filing is mandatory, and then what is the due date of filing return of income, and then we've also understood what happens when I incur a loss, what happens when I forget to file within the due date, and then we have also seen cases which are not covered under the regular cases. So this 4A to 4F are not covered under 139(1) series at all. So these cases, when will return filing be mandatory, we have understood. Now, sir, I have filed my return of income, sir. After filing the return of income, I realized that I have paid advance tax, but I forgot to include it in the return. See, nowadays it gets automatically populated. Nowadays, the department website is so advanced that majority of the things are automatically getting populated, and those who are working on tax-based firms, they will be able to understand it. So the moment you log in and you file an online return without even taking the software, most of them will get auto-populated. Forget those cases. Suppose I have to pay self-assessment tax. What is self-assessment tax? We will study that in the due course. Let us assume that you have arrived at your tax liability to be 10,000 rupees. You have paid only 9,000 rupees till date, so you are paying 1,000 rupees now. So this automatic reflection will generally take 6 days time. Generally take 6 days time. It may happen slightly earlier, but it will generally take 6 days time. You don't want to wait for that long. So you have filed thinking that it is automatically reflected. So what have you done? Your tax liability is 10,000, but you have paid only 9,000. So there will be an option to pay tax. You click on that, you pay tax, come back and you file the return, thinking that it will be reflected. It will not happen that way also. You know why? Because the moment you pay tax, it will still show as if you have to pay tax. Then you will have to go manually enter this amount, then only it will accept it. But let us think for a minute that it has accepted it. Okay, so what has happened? You have filed the return of income. After some time, you realize that, oh God, I didn't include this challan. It is a mistake. This might throw a negative side on myself because department will tell I have to pay some amount, I'll have to pay interest, etc. Headache. Now, is there a chance for me to revise the return? Let us take another example. You have filed the return of income. You have arrived at your refund as 10,000 rupees. Your refund is 10,000 rupees. But you forgot to claim, you forgot to, let us not say claim, okay, you filed the return of income, okay, and you have also paid this tax of 1,000 rupees. Agree. Now, what happened after you filed the return of income? You realize that you have not claimed 80D benefit. If you claim that 80D benefit, your tax to be paid will be only 400 rupees. So, will I lose this benefit or do I still have a chance to claim it? This is where income tax came out with the next concept called as revised return, where you have filed the return and there are some omissions in the original return, or there could be other types of assessees as well. I have filed the return, but I feel bad that I forgot to add one income which I should have added. Please let me add that income, pay tax, and file the return again. Is it possible for this assessee? Yes. So assessees who have either omitted to include any deduction or omitted to add any income, or they have forgotten to add any particular in the return, whether it is possible for them to file a revised return? Definitely yes, it is possible for them to file a revised return under section 139(5). Now, which return can be revised? Which return can be revised? Now, if you see, Up to 2016, only the original return could be revised. Only the original return. What is the original return here? Original return is 139.1 return. Now, sir, what about 139.4 return, sir? 139.4 return was not considered as part of 139.5 up to Finance Act 2016. With Finance Act 2016, 139.5 was amended to include 139.4 as well, which means what? Original return filed and belated return can be revised under section 139.5. Is it clear? Now, if you see the wordings of section 139.5, it will state that return filed under section 139.1 and 139.4. Now we'll have a doubt. Sir, what about 139.3? They have not specified 139.3 here. Okay, sir. One more doubt, sir. You told 139 4A, 4B, 4C, 4D, 4E, 4F. 139 4 is possible. You mean to say 139 5 it will not apply at all? No. Understand. They use the word return filed under section 139.1 and 139.4. 139.3, where does it determine its due date? 139.1. Correct? 139.3, what does it say? You have incurred loss. File the return of income within the due date under section 139.1 to enjoy the benefit of loss carry forward. Correct? Now, 139.4A to 4F. What is the due date? If you have tax audit 31st of October, if you don't have tax audit 31st of July, where is this 31st of October, 31st of July determined from? 139.1. 4A to 4F, they have not filed the return of income. They want to file the belated return. What is the time limit? 31st of December, completion of assessment, whichever is earlier, 139.4. Therefore, 139.5 is referring to the time limit. Time limits are covered only in two sections, 139.1, 139.4. So, how do we read this? Where a return is filed within the time limit under section 139.1 or within the time limit under section 139.4, they shall be subject to filing a revised return. So, this applies to 139.3, 139.4A, 139.4F, from 4A to 4F. So a revised return is not only applicable to 139.1 return, 139.4 return, it applies to every return under the roof. So every return can be an original return, every return can be a belated return or a belated return, and every return can be a revised return as well. Okay, so when I forget or when I omit, then I can go ahead and revise. Now, if I revise, I should have a time limit. For example, current year I made a mistake. 5 years later, I can't come and tell, no, I have to change. Then it becomes too difficult because there are other provisions of assessment which are dependent upon the date of filing return of income. So we need to have an outer limit for this revision to be made. So what is the time limit for revision? 139.5 follows the exact same time limit of 139.4. What is that? 3 months before the end of the assessment year or completion of assessment, whichever is earlier. So 139.4 due date, that is 31st of December or completion of assessment, is the time limit for revising your return. Sir, after I filed the revised return, I found out that there are two interest incomes which I forgot. Can I again revise? Yes. Sir, I revised 2 times. Now I realize that I have not claimed ETTTA. Can I revise? Yes. Sir, now I remember that 3 bank accounts which I should have included in my return, I have not included. Can I revise? Yes. Till 31st of December, you can revise it 108 times or 1008 times or how many ever times you want. Daily in the evening, you can simply go ahead and revise and find the same thing also. There is no restriction. You can revise n number of times till the due date given for revision. So there is no restriction on number of revisions that can be made. So what are they telling? Revision filed under section, return filed under section 139.1 and 139.4 can be revised under section 139.5. Okay, it is vital to note that 139 and 139.4 are mentioned to indicate time limits of original return and not qualification for revision. So even 139.4a is qualified for revision. 139.4f is also qualified for revision. Is it clear? Now, 139.3 can be revised? Yes. Now, what is the time limit? 3 months before the completion of assessment year or completion of assessment, 3 months before the end of the assessment year or completion of assessment, whichever is earlier. So, where have we determined this time limit from? It is exactly the same as 139 for belated return time limit. Now, sir, what happens because of this revision, sir? I have filed return on, let us say, today, as I am giving out this lecture, it is 16th of July. I have filed my return today. I am a person who is not covered under tax audit. So, what is the due date? Sir, are you covered under transfer pricing? Please don't make jokes. We are serious. I am not covered under transfer pricing. I am not covered under tax audit. So, what is the due date? 31st of July. Now, I have filed on 16th of July. Have I complied with 139.1? Yes. Now suddenly I remember that I have not included mutual fund dividends. So what I do is I go ahead and revise my income. I go ahead and revise my income on 30th of August. I revise my income on 30th of August. You know what will happen? When I revise my return, what happens is every information in the return filed on 16th of July, the first return, every information in the 16th of July return will get replaced by the return filed on 30th of August. But the date will remain as 16th of July. So what is the purpose of revision? I will file the original return today. I will file the revised return on 30th of August. When I file it on 30th of August, every information in the 16th of July return will get replaced by the 30th of August return. However, date of filing both in the original and in the revised return will reflect as the 16th of July. Is it clear? That's why if you work in tax firms, you will know the practical difficulty of getting data from clients. Some clients will be like, sir, you should have told us that tomorrow is the due date. How are you expecting us to know? That person would have worked with you for 17 years. There are cases like this. And there are cases like, what? We are covered under transfer pricing. I thought we should have not been covered. Those cases will also be there. So getting data from clients will be a headache. So you know what tax practices will do? They will somehow try to squeeze in and file the original return, at least claiming it as a nil return on or before the original due date's time. 139.1 due date. Before the 139.1 due date, they will somehow squeeze in and file a zero return, nil return. Then they will get the data and file a revised return so that the assessee is not getting troubled because of such a revision. Sir, if we file revised return, will we be subject to 234F? No. Why? Because 234 is F only, 234F applies only if you cross beyond 139.1. When you revise, what happens? Date alone remains same. Everything else is changed to the revised return. That is the importance of the revised return concept. That's why people don't opt for belated. They will quickly file a zero return and then they will subsequently revise it so that they can file the final return based on the same. Is it clear? Now, let us see some examples to understand this better. Due date of filing return of Mr. A for AY 22-23 is 31/7/2022. Assessee filed his return of income on 10th of June 2022. Now, what was his due date? His due date was 31st of July 2022. But when did he file the return of income? 10th of June 2022. Has he complied with section 139.1? Yes, he has complied with. So, within 139.1 due date. So, is it a normal return? Yes, it is a normal return. And what did he do? He declared an income of 20 lakhs And on 10th of November 2022, he identified mistakes in the return of income and filed a revised return on 10th of November 2022, revising the total income to a loss. So initial return was what? Initial return was original return. He filed it and it was a return which had income, and the subsequently revised return has a loss of 8 lakhs. Now the question, whether revised return can be filed, whether loss can be carried forward. How do we understand this question? First point of the question, whether revised return can be filed, for which what should be answer? What is the time limit for revised return? Which is going to be 9 months from the end of the, 9 months from the beginning of the assessment year, that is December 31st, 2022, or completion of assessment, whichever is earlier, or 3 months before the end of the assessment year, or completion of assessment, whichever is earlier. Question is silent about completion of assessment, which means assessment is going to be completed later. So what is the first event here? It is going to be 3 months before the completion of assessment year. So what is 3 months before completion of assessment year? 31st of December 2022. So the person, what is his name? Okay, Mr. A. So Mr. A has time up to 31st of December to file the revised return. When has he filed the revised return? He has filed the revised return on 10/11/2022. So is the revision valid or not? Yeah, the revision is definitely valid because he has completed the revision well before 31st of December 2022. Now, what is the next question? Interesting question. Whether loss can be carried forward. Now we are put into a serious situation. Sir, 139.3 tells that return should be filed within 139.1 due date if loss has to be carried forward in the year in which loss is incurred. Have they incurred the loss for the current year? Yes. Have they filed the return of income or indicating the loss within the time? No. The loss return was filed on 10/11/2022. Can they take this return? Can they take the losses and carry it forward? Blind reading would tell no. But remember what we recently understood. When I file a revised return, every data in the return will be changed, but the date of filing will remain to be the same. So if we understand this portion, what will happen here on 10th November? On 10th November, every page in the return of income will be changed. Every page in the return of income will be changed. Total income will be changed. Tax will be changed. Loss will be changed. Everything will be changed. But the date of filing will remain to be 10/6/2022. Is 10/6/2022 in line with 139.1 due date or not? Yes, it is in line with 139.1 due date. If it is in line with 139.1 due date, I am automatically complying with 139.3. Therefore, I can carry forward this loss. So what have we understood? 139.5, when I revise the return of income, every particular in the return will change, but date of filing will remain to be the original date of filing the return of income. So which means what? I am automatically satisfying the conditions of 139.3. Therefore, there is no question of debate on carrying forward this loss. You are definitely eligible to carry forward this loss. But are there any litigations on this, sir? Definitely there are litigations. However, that is not a point of concern right now. When we see case laws, probably we'll see one or two cases where there are contradictory views, but still, however, this view has always taken the precedence. Now, let's take the next example. In the above example, if assessee had filed the original return of income on 11th of September 2022, what was his due date? 31st of July. But when has he filed the return claiming 20 lakhs? 11th of September 2022. Revision he has made on 10th of November. Now, can he carry forward loss? What will happen on 10th of November? Every particular in the return will be changed, but date alone will remain as 11th of September 2022. Is 11th of September 2022 within 139.3, 139.1? No. Therefore, he will not be eligible to carry forward the loss in second example. However, he can set off the loss for the current year. Is it clear? So this is our understanding of 139.5 clubbed with 139.1, 139.3 and 139.4. Is it clear? Fine. Now, the next section that we are going to look at is section 139.9. Now, what happened? Let us say for this year, I have sold some property. Okay. Till this year, the only source of income I've had is, excuse me, the only source of income I've had is salary income and some small interest. Assuming that this year I have sold some property. And my knowledge in tax is very minimal. So what I do is, based on my past experience, I quickly log into the income tax website, go choose file ITR and choose ITR 1. I have filed the return of income. And I am very happy that whatever is reflected in 26 AS is getting reflected here. Correct? Because 26 AS is not going to show property unless until TDS provisions are going to be applicable. That happens only when your property value crosses 50 lakhs. I am a small person. I have made 30 lakhs odd worth of property sale. So that is not getting reflected as well in 26 AS as a TDS portion. So now what has happened? I am happy. Department sends me a love letter. They tell me, boss, you have a property sale. Why have you not shown that? There is a defect in this return. Kindly rectify this return and share it with us. I am surprised as to why and how did they find it out. That we will discuss when we get into the department side of the story. Okay. Or probably to make life easier, let us say that, for example, I am supposed to file ITR 3 or ITR 4, but I have filed ITR 1. Let us not get into the transactional details. Sometimes it could be confusing. Instead of filing ITR 4, I have filed ITR 1. Or in the same example, property value, let us say it is 60 lakhs. It is reflected and I go through ITR 1, I see that, oh man, no capital gains is there in this ITR. Probably ITR, you don't have to reflect capital gains, I think so. And then I file the return of income. I got capital gains, it is reflecting in 26 AS, but in ITR 1, there is no capital gain. So I feel that, okay, probably capital gain need not be reflected in ITR 1 and I file it. Department sends me a notice under section 139.9 telling that, boss, your return is defective. You have filed the wrong return. So what is the section about? Defective return. So when will this defective return come into play? Suppose I have to fill in every applicable column which applies to me in an ITR, income tax return. But there are 2-3 columns which I don't fill. And these columns are required for the purpose of ascertaining the total income. Okay. Now, since I have left these blank, the total income is also incorrect. So in this case, it is called a defective return. Now, case 2. People who have done tax-based articleship will understand that there is a sheet called sheet BP, sheet OS, etc., OI, where you try to identify the income under various heads and then arrive at sheet TI, where you arrive at the total income. Now here, suppose for one of the heads of income, I have not provided sufficient data, or I have not filled in the data required for these particular heads of income. What happens? I am not giving sufficient information for determining the total income. Then I am a person running on business and my turnover is more than 10 crores. I am subject to tax audit, but I have not given the tax audit report along with the return of income. Then I have straight away gone to the sheet TTI, the sheet where the total tax payable is determined and the tax paid is reduced. Under the tax paid column, I manually key in a number. And then it shows as 0 tax payable and I file the return. But I have not given the details of challans with which I have paid these taxes. Okay, there is a column, there is a sheet where you will have to go ahead and declare the challan number, PSR code, etc. But I have not done that. So because of this, what happens? The department is unable to match the payment with challans, so they are telling me, boss, this return is defective. Then I am maintaining books of accounts and I am auditing, I'm getting the books of accounts audited. I'll have to submit the audit report and I'll also have to share with them the copy of books of accounts as well. What do I mean by share with them copy of books of accounts? In ITR 6 or ITR 4, I'll have to give them details of assets and liabilities, and I'll have to give them a proper report of whatever is the total value of assets and liabilities maintained by me. I should also show what is the manufacturing account and P&L account and the profit or loss made by the business during the year. Suppose I am a person who does not maintain books of accounts, then what will I do? I will have to make sure that a statement of turnover, a statement of assets, and probably profit statement should be submitted along with the total list of debtors, creditors, and stock in trade that is held by me. So these are supposed to be given as part of the return of income. Suppose any of these are not given, department will issue a notice under section 139(9) and they will call the return a defective return, and they will give you 15 days time. They'll give you 15 days time and tell you to rectify the defect and file the return of income again. So they'll give you 15 days time and they'll ask you to file the return of income after rectifying the defect. Suppose you feel that 15 days is not enough because you'll have to collate data, you can make an application to the income tax authority asking for more time. You can make an application asking for more time. So you may get an extended time as well. You will have to file the return of income within the 15 days or such extended period which is granted by the authority. If you fail to do so, your return will be treated as void and it will be treated as an invalid return. They will not consider it and they will treat as though you have not filed the return of income at all, and they can even proceed to complete the assessment as a best judgment assessment. What is best judgment assessment? Don't worry about it. It's called as ex parte assessment. It is concluding the assessment without the involvement of other party, which is a very dangerous assessment. Okay, so what do we understand from this? You will be given 15 days. You can ask for more time also, but you will have to file the return of income. If you don't file the return of income, what will happen? You will be treated, the return will be treated as void and it will be treated as an invalid return, and it will be treated as though you have not filed the return at all. Sir, let us say that he's taken it up on assessment. I have not responded to him on 15 days. But after 40 days, I have filed the return of income. He's not given me 40 days. He's given me only 15 days. But after 40 days, I have filed the return of income. Will he consider it? He has the power to consider it. You can go and make an application telling that please condone the delay. I should have filed in 15 days time itself. I was unable to do it. However, I have filed it now. Kindly condone the delay and accept the return filed now as a valid return in response to 139(9) notice. The AO has the power to condone delay and accept the return filed by you. In that case, it will be treated as a valid return and not as an invalid return. Is it clear? Now, there are two other small sections, very small sections. These sections are generally not tested from the examination point of view, and it is more of a procedural section. Since it is part of your study material, I have given it here as well. Generally, when you file the return of income, documents are supposed to be furnished along with the return of income. Suppose you are claiming any exemption under any section, you will have to give the details of the exemption claimed for the period, and then you will have to give disclosure of assets held outside of India where you are a beneficial owner or a beneficiary. Then whatever list of bank accounts that you hold as of the date on which you file the return of income, you will have to give a detail of the entire list of bank accounts that have been held. Earlier, this credit card spending used to be a rage, and so they used to ask you details of whatever be the credit cards that you own along with the spending that you have made with the credit cards. Wherever there are statutory limits or thresholds that are given for certain expenses, if you cross those thresholds, then you will have to give a disclaimer, and you have to give a disclosure as to what are all the expenditure where the limits that have been specified have been crossed. Now, 139(6)(a) applies only to an assessee carrying on business or profession. So they are required to make certain additional disclosures apart from 139(6). What are they? You will have to submit a tax audit report under section 44AB. And if audit report is already done, that is, in case you're already done with the tax audit report, a copy of the report and the details of furnishing it earlier should also be given as part of your declaration. Then you have to specify what is the principal place of business. You have to specify what is the principal place of business, and if you are part of an AOP or a partnership firm, names of the other members or partners and the shares in profits that are being held by them should also be disclosed. So with this, we have concluded upon 139.4a to 4f, 139.5, 139.6a, and 139.9. So almost all provisions corresponding to the return filing aspects are complete. So what else is still left over on the assessing side of the story? One, PAN number and its usage. Two, Aadhaar number and its coding. Three, self-assessment tax. And then four, annexureless return. Five is going to be your signing authority, and then that will conclude our understanding on the provisions of assessee side of the story. Now, the portions that I have discussed as the leftover parts will be even more theoretical. So before we go to that direction, let us take a slight departure from the assessing side of the story, jump into the department side, understand how they process the return or how they choose assessees for the purpose of assessment, what happens in this procedure of assessment, what are all involved, what happens before the assessment commences, while the assessment goes on, after the assessment is complete. So these stories we will venture into in the next lecture. Okay, so this will be a different lecture. Like transfer pricing, what we will do, we will take up a case study and slowly unwind the provisions of assessment procedure. Till now, it was more time limit based and condition based, and from now on, it will become more of a story. So, probably you will be able to understand and appreciate it better if you stick on for the entire length of the lecture. Okay, I will again put out 3 or 4 lectures on department side of the story as well. I would require your feedback as to whether you are able to understand and appreciate the provisions, so that I can continue putting lectures on assessment procedure till the entire chapter is complete. Okay, so I would be waiting for feedback, so that will also help me improvise as well as choose to see if some other topic can be better handled in this regard. Okay, so we'll catch up in the next session with the department side of the story. Thank you, please.